day, everyone. This is the Money Wheel on CNBC. I'm Dean Shepard.
And I'm Sue Herrera with
And welcome to Money Talk. I'm Ted David. Today's topic, variable annuities. Joining us to answer your questions about how variable annuities work and if they can work for you is Jerome Golden, chairman of Golden American Life Insurance. And, of course, we invite you to give us a call at 1-800-752-CNBC. Good to see you. And before we start and get too deeply involved, let's do some definition of terms if we can. What is an annuity?
Annuity is a contract issued by an insurance company that an individual would purchase to accumulate funds for retirement.
Now, there is a variable and there is a fixed. What's the difference?
A fixed annuity where the funds are invested by the insurance company, where they credit you at a fixed interest rate and guarantee your principal. A variable annuity is an annuity where the funds go into a choice of professionally managed portfolios and where the results are dependent on the investment performance of the particular portfolios.
So the risk tolerance then has to be a little bit greater than for a variable than for a fixed.
Right. Fixed has the guaranteed floor. The variable goes up and down with the market.
Okay, that's for the benefit of you folks out there who weren't quite sure what these were all about. Now we're going to talk about immediate annuities, which you say is going to be the retirement vehicle of the 2000s?
Well, I think there's been a lot of money accumulating toward retirement, but one of the questions, what do people do when they want to start receiving an income? They can take out systematic withdrawals out of a variable annuity, or they can buy an immediate annuity, which will guarantee an income for a period of time for their life or for a fixed period. We think with the aging of the population, there'll be more immediate annuities and more choices within that category.
Explain to me how it works. I come to you, and is this only for senior citizens, by the way, or is it for anybody?
No, it's generally for senior citizens, but if you have an obligation over a period of time, let's say a college education, 3 kids for over 12 years, you might want to buy an immediate annuity. But they operate, if you come with a sum of money and want to buy a fixed immediate annuity, you give the company that sum. They promise over your future lifetime or a fixed period to pay you a fixed sum of money. And they invest it over long term, and they either gain or loss based on that investment. In a variable immediate annuity, you give them a sum of money. You start out with a particular payment, but over time that payment will reflect the performance of the underlying investment portfolios.
Now, the one thing that's key here is that you mentioned is that over time they'll make or lose money. What happens to your principal, even in an immediate annuity? You're guaranteed, as I understand you said, for the first 6 years you're guaranteed to pay out. Then what happens?
Well, in a guaranteed fixed annuity, you have a guarantee for the entire period. But for certain variable immediate annuities, your payment is stabilized for a 6-year period, and at the end of that 6-year period, based on the performance, the payment is reset. It could be higher, it could be lower, but during at least the first 6 years, you can know what payment to expect.
And what's happened to your principal in the interim?
Well, the principal has been invested according to investment portfolios of your choice. Could be in a bond fund if the retiree or investor is conservative. It could be in a balanced fund between stocks and bonds, and it could even be in an equity fund. The investor is at risk, but hopefully over the 6-year period, the performance will be higher than they could have gotten in a fixed guaranteed product for life.
Okay, let's take our first call. It's from Henry in Michigan. Hi, Henry.
Hi, how are you?
Very good.
Good. I was wondering, I know that variable annuities are offered by insurance companies. Should I be worried if anything were to happen to the insurer with my money in a variable annuity?
That's a good question. In some variable annuities, some assets go into the company's general funds, but let's talk about, in most situations, in a variable annuity, the funds go into a separate account, which are segregated from any claims of other separate accounts or the general account of the company, and so that they are always liquid and they are not subject to any other claims. You've even had some of the companies that have had financial difficulties where the variable annuity in a separate account was continued to be accessible and available to the investor.
Okay, Murray is standing by in New York. Hi, Murray. Welcome to Money Talk.
Thank you. My question is, I'm 62 years old.
50 or 60?
62.
Okay.
And I have about $65,000 in IRA, which is not paying any interest. I would like to switch to annuity. What kind should I get? My lifespan, I have a heart problem, might be 5 years, hopefully.
Let's hope it's a lot longer than that. Okay, what would he do here?
You've got an IRA and you're looking to distribute. There's a number of things you consider. One, you can start taking out principal and interest out of the IRA, and at 70.5 you have to do it according to a certain schedule. You could apply it to a guaranteed annuity for life, but if you're concerned about your life expectancy, the odds may be against you. So I think more than likely, if you like the form of an annuity, you might have it paid out to you over a fixed period of time, 5, 10, 15 years. You don't forfeit anything on your death, and in most situations, those funds are available to you in case of an emergency. So you might want to go what is known as a fixed period annuity, so that the funds are always available to you, as opposed to a life annuity where, in fact, if you have a shorter life expectancy, you would forfeit some of the funds to the insurance company.
Yeah, let me ask you about that. In reading your literature, do I understand, though, that if something were to happen to you, that you can name a beneficiary who then would continue to get the payout from this, or who could immediately surrender it and get a cash value?
Yeah, in the particular income plan that we've developed, it is a certain annuity, which means it's payable over a fixed period, but also you can access that fund at any point. If you need it, you can draw out more, you can surrender it, or if something happens to you, your beneficiary steps into your shoes and begins receiving the payments. Very different than what is known as a life annuity, where they have no right to liquidity, and they may have very limited rights as a beneficiary.
All right. Darren in California. Hi there. Good morning.
Hi, good morning. My question is regarding the interest rate my annuity would get during payout. Let's say I take a 10-year payout. What kind of interest am I guaranteed on that payout? Is it the current rate, or how does that work?
Well, again, if you're buying a fixed guaranteed annuity, typically the insurance companies guarantee the rate for the entire period. They invest in a pool of assets, and they try to match their assets with the liability. In the case of a variable, where you're going to get the direct performance of your portfolio. So if it's in a stock fund, you'll get that performance. If it's in a bond fund, you'll get that performance. If it's in a balanced fund, you'll get that. But typically in a fixed guaranteed annuity, the interest rate has been locked in for the entire period of time, and the insurance company has matched its investments with its liabilities.
Now, one of the things that you mentioned in your immediate annuity is that I can have the likes of Marty Zweig deciding what stocks I'm going to own. How does that work?
Well, in the particular program that we've developed called the Specialty Manager, we have a choice of professional managers, each one managing their own specialty. Marty Zweig manages an asset allocation fund with a bond tilt. We have another firm, Weiss Peck & Greer, that has an asset allocation with an equity tilt. We have somebody who has real estate securities, natural resources, and fixed income. You have a choice of 8 portfolios. You can be in one or all 8, and you have the ability to move between the 8 without any tax consequences and any charges.
What about tax advantages of this kind of vehicle?
Well, in an immediate annuity, if you make that election, each payment that you receive, a part is considered a return of principal. So in the case of this particular program, in the first 6 years, about 60% is considered return of principal and therefore is free from tax. So you're going to be taxed on the 40%. That return of principal will be considered for your entire period, and so you have some tax advantage in an immediate annuity.
All right, Fran is standing by patiently in Connecticut. Hi, Fran.
Hi. I deposited $25,000 in an annuity for 5 years, and I was supposed to get like 9% interest with a cap of $850. I got it the first year, but the second year they dropped it down to $760, and they asked me that I could very well withdraw without any penalty. And I was a little curious as if I had put that money in the bank and I made a contract, I would have gotten the 9% for the whole 5 years. Now, are those annuities, can they do that?
Yeah, there are different kinds of annuities where some annuities have an underlying relatively low guarantee of 4%, and they illustrate a high crediting rate in the first year, and they give you the right, if they do lower the credited rate below that first-year rate, you do have the ability to bail out, if you will, without any surrender charge. So those are what we call one-year fixed annuities. There's some that guarantee a rate for 3 years, some that guarantee a rate for 5 years. Typically, the 1 year will be start off a little bit higher, recognizing the insurance company does have the ability to drop it. On the other side, they do run the risk of your ability to surrender it without a penalty through this so-called bailout provision.
Teresa in New York, hi.
I was wondering, I've got a 401 plan, and I'm 43 years old, and I have everything right now in non-risk, and the percentage obviously is very low. What would your recommendation be in terms of risk, medium risk, and no risk?
Well, I guess...
That's kind of individual.
Yeah, it really depends on the individual. I think you're 43 and you've got a fairly long period between now and retirement. And our philosophy has been in the design of our products to encourage, wherever possible, some greater percentage in equities. History has shown that equities will outperform fixed income and treasury bills. And so we like to encourage people to take a little greater risk, particularly if you have a relatively long period of time toward which you need the funds.
As one of our guests said, though, there is the sleep factor. You have to be able to sleep at night. One quick question. For whom is the immediate variable annuity not a good investment?
Oh, well, I think the immediate variable annuity has been designed for somebody sort of in a transition between active retirement and full retirement. We like to think it's the buyer is a 60 to 70, 75-year-old. At 75, I think they really want to sleep at night. They want the full guarantees of a fixed immediate annuity where they don't have to manage. So it's that transitional retiree, I would say 60 to 75 is where it fits.
Okay, got to leave it there. Thanks for joining us.
Thank you.
Interesting topic. Jerome Golden, Chairman, Golden American Life Insurance Company. A reminder that the advice given here in Money Talk represents the views of our guests, not the network. Short break coming up, and then the Money Wheel back with Dean and Sue, and a check of the latest action in the credit and futures markets. Also, a look at this hour's winners and losers straight ahead on CNBC. We'll be right back.